Good afternoon, everybody, and welcome to Topstep's group coaching session. We like to call it Let's Crush 2023. It's kind of amazing how soon I'm going to have to change that to 2024. Welcome, everybody. My name is John Hoagland. I'm a senior performance coach here at Topstep. I've got 40 years, industry years, more like 30, 31 as an active trader. I traded on the floor of the Mercantile Exchange for 20 years. Migrated to screen trading in 2009, and since 2011 through 2012, I have been here at Topstep, trading and hopefully helping traders develop here and get a greater knowledge of the futures industry and futures trading, and hopefully improving your performance, which is what today is all about. We're seeing a lot of questions about profile. What's a point of control? What's a naked point of control? What's value? What's a weak high? What's a weak low? And I'm going to be taking pieces of previous webinars that I've done to do my best at explaining what the profile is, talking about a lot of the vocabulary that I talk about and that we talk about sometimes on TopstepTV, and to give you a better kind of basic knowledge of what the market profile is, as well as some information about the volume profile. You'll probably see as we go through here that I'm much more partial to the market profile, but I'm always keeping an eye on the volume profile, because there are certain periods of time, there's certain things about it that I find more useful at certain periods of time than even the market profile. So what I'm going to do here is I'm going to start right off the bat just by talking about the market profile and how it is a different way to organize the information that the market is giving us. Many people, including Jim Dalton, who I call the godfather of the market profile, calls the profile market-generated information. It is not an indicator. It is not a tool where you're going to be able to wrap a specific strategy around it. It's more a tool to wrap context around the market. Okay, so when we're going to take a look at this finished profile, and we're going to put together a profile throughout this presentation, so you can see how it is put together. And we're going to start by talking about a little bit of the vocabulary and the different features of the profile. The first thing to recognize is, like any system of analysis, it takes time and experience to become proficient in its understanding. I have been looking and using the market profiles for 30 years as a trader, approximately 30 years as a trader. I didn't really have it for the first couple of really tough years as a trader, and I really kind of credit the market profile for keeping me in the markets for as long as I have. Information can become available in real time. In other words, market-generated information can be a non-lagging indication of potential changes in the market and in the marketplace. The information that becomes available in the profile sometimes can be severely contrary to popular opinion. I've noticed this already in TopstepTV when I'm thinking about taking a trade, and a whole bunch of people chime in and say, I wouldn't do that. I wouldn't do that. And then we watch the trade, play out to some degree in the favor that I was looking for. And that nothing happens the same way ever twice. And once we do get the right answers, the market is going to change the questions. Of course, the one thing that remains constant is the ability of the market profile to provide that market-generated information. And like anything, you have to be honest in your review and in your competence of understanding the market profile. That's true of anything. If you're a technical analyst, if you're using indicators, whatever you're using, it takes time to become competent in using it. Reviewing your ability to recognize the situations and the opportunities with whatever tool you're using is, of course, going to take time, because we all know that we don't know what we don't know. 30 years I've been studying the profiles, and I still learn something from them very often. So the market profile is based on bell curve theory, the Gaussian bell curve theory, showing the concentration of acceptance through time in the middle of the bell curve, and areas of rejection or little or no time on the extremes. When this changes, when an area of balance is rejected, that is an indication of potential change in market state, market structure, and context. Okay. On the profiles, and I think that most of us are going to really kind of believe or feel that we're visual learners. I believe everybody is to a degree, but visual learners are going to learn a lot from looking at the market profile graphic. Okay. So these vivid visual changes that are going to occur as the market changes from balance to imbalance. If you were to get down to the cut and dry of it, markets are in two basic market states. I know people that rat hole market conditions and market context into up to 24 different market states. But when it comes down to the basics, the market is either in balance, range bound, consolidating, chopping, whatever word you want to use for a range bound market, and then it becomes directional, trending, one time framing. These are two basic market states that when you look at a profile that is finished, will be obvious. Well, the market was balanced here. It fell out of balance and moved to another area of trade, and a new area of balance began. The market spends most of its time in balance. It spends less of the time in directional activity, trending, whatever you want to call it, in the day time frame. So the vocabulary is in and around the market profile. The time price opportunity, the TPO. It's each of these little building blocks. Point of control. A lot of folks wonder what that is. In market profile, it is the widest line of TPOs that's closest to the center of the range. The point of control is considered the fairest price of the day. It's been the most visited price for the entire session. Value areas. Well, this red caret right here indicates the TPO point of control. This purple one indicates the volume point of control. The volume point of control is the highest volume single price. It is also can be considered the fairest price of the day. It attracted the most volume. Okay. The initial balance. We talk about that quite a bit on TopstepTV. The initial balance is, generally speaking, the first hour of trade. On this platform, it's represented by this dark blue line. The opening range, the first minute of trade. There are lots of different ways that people use the opening range. Some people look at a 30-second opening range. Some look at a 5-minute, a 10-minute, a 15-minute opening range. Some people actually call the initial balance the opening range. Be consistent in how you use the opening range. Therefore, you'll get consistent results and consistent information for review. The opening range is an old pit term. When the bell rang, there were brokers that had orders that were due fills right on the open. If it was a quiet day, the opening range may take 3 ticks and 20 seconds to establish. If it was a busy day, the opening range may take 5 full points or handles, if you will, and 3 minutes to finish. But in electronic trading, if there's something I want to get done right away, I think a minute is long enough. Therefore, I use 1 minute for the opening range. Now, one of the features and one of the nuances of the market profile are buying and selling tails. This C period, these two little TPOs sticking out the top here, indicate a selling tail. Price got too expensive. Buyers wouldn't buy it there anymore. Sellers quickly moved price back into the body of the profile. We do not have a buying tail at the bottom of this profile. One little TPO sticking out is not excess. We're going to talk more about poor, unfinished highs and lows as we go on. There are also some things called anomalies. An anomaly is anything that really doesn't fit in the profile, and we'll see more examples of that later. Now, the one thing that I kind of went past on this is the value area. The value area high and the value area low. In market profile, it should be, I think, 67.5% of the time in this range is spent between here and here. I just expand it to 70%. So at the end of this day, we know that value was between this price and this price according to time. Volume value, the same value high and a little bit different value low. What is the major difference between volume profile and TPO or market profile? The constant in market profile, TPO profile, is time. Each 30-minute bar is represented by a different letter or a different block. Those blocks are all stacked up to the left axis so that we can create our Gaussian bell curve, so we can see where value is and where we may be trading outside of value. So in TPO or market profile, the constant is time. The variable is price. Price can go anywhere at any time, but as long as we keep the time constant, we're going to get this picture of the Gaussian bell curve and when price may be leaving an area of balance, seeking new trade facilitation. What is the market's job? The market's job is to facilitate trade. Price will always be seeking the level where traders, investors, whatever it is, are comfortable conducting business, where buyers meet sellers. That's where balance is. When that changes, when there's stronger sellers and few buyers, price is going to move lower. You're going to get a directional move. Then once the market finds that area of price that is perceived as value, you will return to two-sided trade. I would call this a two-sided trade profile. The market opened, it looked above the initial balance, it rotated back down below the initial balance, and finished the day right in the middle of the range. This was a range-bound day. Okay. The volume profile, however, price is always the variable, but volume is the constant. Now, volume is constantly changing, but in collecting the volume the way the volume profile does, it becomes the constant. If the market is spending a lot of time here, it makes sense that somewhere in that area, the volume is also going to increase at that level over time. So price always the variable. In TPO profile, time is the constant, volume is the constant. Now, it's kind of blows my mind, or it strips my gears a little bit to say, well, volume's always changing. Well, yes, but as long as we continue to stack the volume per price, it can then become the constant. So the building blocks of profile, a little bit of a review here, but each little bar, each little block here represents one tick. The A period is the first 30 minutes. So the opening range, the first minute of the session, initial balance, the first hour of the session, value area, where 70% of time has been spent based on the position of the point of control. Okay, point of control, the widest line of TPOs closest to the center of the range. Okay, it's considered the fairest price of the day. It's been most visited, therefore it is considered the fairest price of the day. It's a comfort level. And when we start to look at naked points of control, you'll see how powerful these naked points of control can be. The excess or rejection. A period left single TPOs here and the price started moving higher. This is a buying tail. Price was perceived as too cheap for sellers to continue. Buyers took over, and the market has become now directional to the upside. We would call these buying tails and or selling tails excess. In other words, a period opened, looked lower, and left quickly, creating excess. Excess, rejection, buying tails, selling tails, all mean basically the same thing. So when we look at this profile, and I know we're not seeing the actual letters, there's some features that we want to take a look at here. 6. This is a weak high. There is no excess on that high. If you were watching TopstepTV today, I gave Michael a caveat, and because we had put in a weak low earlier in the session, at the low of the session, I said, look out, Michael, because this is likely to be revisited at some point today. And boy, was it. The market extended relatively substantially below that level. It is now returned to balance, but the weak highs and weak lows are areas where the market hasn't proven to be unfair. An excess high is unfair to buyers. Sellers will take over. So in this particular market, the market looked, opening range is close to the high of the day. We took one look above it, not a strong high. The market rotates lower. Point of control ends up being it by the end of the day at this price. Why? Because it's the widest line of TPOs closest to the center of the price. It's considered the fairest price of the day. When we start to look day over day at profiles, sometimes we'll get what we call an afternoon high. This afternoon pullback high pointed to right here can be an important level in the next trading day. It's where buyers failed to rotate price higher and the market continued its move to the downside. An anomaly is anything that sticks out that doesn't fit. Typically an anomaly we're going to call a single TPO sticking out the side of the profile graphic. This little TPO sticking out here is an eyesore and has a big magnetic property in future possible trades and opportunities. When we look at the point of control, it looks like an anomaly as well. And then the late spike. A late spike is when the market drives lower and closes. In other words, cash close. This is the S&Ps. If the 2:30 to 3 o'clock bar extended the range and closed down here, it doesn't get time to show acceptance through time. So we look at the next day and we say, well, did we open below the late spike? That's a good probability of acceptance of lower pricing. Even opening inside the late spike is kind of a secondary, but a pretty good probability of acceptance of lower pricing. When that happens, I look for opportunities to sell the market when it exhibits strength. Okay, so we're going to put together a profile almost, I guess, in real time, right? So here we have our opening range. We have the first half of our initial balance. The A period, first 30 minutes, ranges from this price to this price. Each price gets a TPO, a time price opportunity. What the hell does time price opportunity mean? Well, the market traded at a price at a time where you had an opportunity to trade it. The time was here, the price was here, you had the opportunity to take a trade. So the first 30-minute range is right here. B period opens up and extends the range lower below the low of B period. So when we take a look at the first 30 minutes, the point of control, the TPO point of control, is right in the middle of the range. It's the widest line of TPOs closest to the center of the range. That's where it has to be. But B period opens up and extends the range and the initial balance lower. What does that do to the point of control? Point of control starts out moving lower. It went from here to here due to the range extension. So now this becomes the fairest price of the day. Value, basically just kind of showing, obviously, 70% of the trade is going to be between here and here. We only have one price bar overlap here, and that's going to basically give us our value area. Volume, a little bit low down here. Volume value is a little bit tighter. C period opens up, doesn't take out the low of B, and begins to rotate back higher. Does it change the point of control, the position of the point of control? It does not, because C period comes back to the center of the range. The center of the range remains the widest line of TPOs horizontally, closest to the center of the range. The one thing that we do notice did change is the volume point of control. Volume is presenting as a little bit higher here already. We have a degree of excess on the low. We've moved point of control higher. D period opens up, takes out the high of B and C, but doesn't take out the high of A. So right now we have excess at the high, we have excess at the low, we have the volume point of control moving actually back lower, closer to the center of the range and the TPO point of control. So through 4 30-minute periods, right now, we are looking at a normal trading day. A normal trading day is a day that never extends outside the initial balance. Normal trading days are extremely rare. Rarely do we see a range that does not extend outside the initial balance. Let's move along. E period. E period comes, trades up to here, takes out our excess on the high here. Now we have a weak high. It has now also moved our point of control higher. Now this becomes the widest line of TPOs closest to the center of the range. Is the point of control migration telling us something? We have excess at the low, no excess at the high. As the day goes on, we're seeing our point of control move higher. E period took out our excess at the high. F period moves point of control yet a tick higher. Our volume point of control remains here. F period doesn't take out the high of E or A. Still low excess high here. So you can see every 30-minute period, we put the range, each tick gets a TPO, and everything is pushed to the left. So we can see if our bell curve is symmetrical or asymmetrical. Right now, we're creating an asymmetrical bell curve. The market is spending more time creating more volume at higher levels. We have an excess low, we have a low excess high. The next 30-minute bar, G period, comes and tests below value. Doesn't change the point of control. Point of control is going to be pretty much landlocked at this level relatively soon. H period trades from here to here, takes a look down below G, puts in a kind of a poor low there, but we know we have excess at the low and a low excess high. We've got a high point of control. We've got an asymmetrical bell curve. What does this profile look at the end, like at the end of the day? B period buying tail remains. We extend the range higher. We extend the range higher yet again. We finally find excess at the top here, and then the market closes. Point of control remains here. It was going to be pretty much landlocked there anyways over time. But now you've got, I think, hopefully a better idea of how the profile graphic is created. Okay. Now, when we look at the volume profile, we don't see some of the detail that we do see in the market profile. When I look at this volume profile, there's not a lot of volume here, but I can't tell if this is an excess low or if it's just low volume. Okay. Do we have, oh, I'm trying to move the chart. We have excess high here, but I wouldn't be able to see that in the volume profile. So the volume profile, while it has its uses, I don't think produces as much information as the market profile. So if we were to split this profile into vertical lines, this platform actually gives me the open and the close for each 30-minute bar. We're basically looking at a 30-minute chart. A 30-minute chart. That's what we're looking at when we're looking at this. Just the fact that the information is organized in a different way is indicative of how the profile graphic can change your view of what we might see on a 30-minute chart. Now, I look at 30-minute charts because I look at profile because they're congruent. They're very similar in time frame. Consistent time frame, I believe, is very important in anything that we're doing in trading. Okay, so we've put together a market profile together. We've seen how the market profile lines up very nicely with the 30-minute chart. This is the diffusion of innovation. It is a Gaussian bell curve. When there is a new innovation, let's call it, well, in 1982, the CD player came out. They were really expensive, but the first people who bought them had the most time to enjoy them. They were the innovators. Then the early adopters came. Then you've got the early majority, the late majority, and the laggards. Well, I mean, what are we looking at here? We're looking at basically 68% is value area. Value area. If we put this on its side, here's a bell curve. Now, if we're in two-sided trade, innovators were the buyers here. The last to buy it up here were the laggards, but you can almost put that Gaussian bell curve right up here. Innovators, early adopters, buyers at this level, early majority, still can profit. Late majority, you're going to get less opportunity of profit and you're going to increase your risk, and your laggards are going to be the ones that are going to buy it here. On the other side of it, the innovators would be the sellers up here, early adopters, early majorities, and so on and so forth. And this is in a rotational market. In a directional market, your innovators were the ones buying down here, the early adopters, early majority, late majority, and the laggards were the last ones to buy it at the high here. So the Gaussian bell curve, to be able to recognize range-bound trade, you got a little bit of a Gaussian bell curve, but then the market, something changed and the market became directional. So there are different types of day types, and I don't want to get too involved in all of that here just yet. The non-trend day, or this is a normal trading day, right? The initial balance is the extremes of the entire session. These are rare. Typically, you may see a normal day or a non-trend day, which is a very small range with very little or no range extension outside the initial balance before a holiday. Before a holiday. Double distribution trend day. Balance, bell curve, time, something changes, Price moves swiftly away from that and begins to create a new area of balance. Double distribution trend days happen a lot during economic releases that occur later on in the day. A trend day is basically a day with the opening range at the low of the day, dead ass low. Usually there will be a degree of excess down here on this particular graphic. There isn't, but the market drives higher. Every 30-minute bar is a higher low, higher high. This is a trend day. Now, what we see most of all is a normal variation day. A neutral extreme day is a lopsided bell curve. Now, it can mean one of two things. Long liquidation, the B shape gives you the long liquidation. A P shape gives you short covering. And remember that these neutral extreme, if this is long liquidation is actually taking initiative selling away from the marketplace. A normal variation neutral or center day, is a day that did a good job of facilitating trade. What's the market's job? Oh yeah, it's to facilitate trade. If the market has finished its ability to facilitate trade, price may move to a new level to facilitate trade. So the market's job, again, facilitate trade. I don't want to overdo that. So when we're looking at the profile, when we're looking at anything, we should be asking ourselves, what is the market attempting to do if it's attempting to do anything? Is it attempting to go higher? If so, how good of a job is it doing getting there? So on the opening call, we talk about volume and open interest. A market that is consistently moving higher on higher volume and open interest is more likely to go that way. So if I were to look at a market like that, and I would say, well, price is moving higher on higher volume and higher open interest. The market is moving higher and it's doing a good job. I'm looking to buy weakness in that market. Same is true in the opposite direction. If the market is moving lower on at least maintaining or increasing volume and open interest is coming in, additional open interest, that is a strong auction. I'm not going to fight that. I'm going to find opportunities to sell it when it exhibits strength. Now, there's a couple other things here. This is a true poor high. C period traded up to here. D period took out one little tick right above it and then moved back to the downside. When I see a poor high or a poor low, I think about a bunch of kids standing around a pool and they're not sure if it's cold. So one kid finally sticks his toe in and says, it's too cold right now. Let's come back later. I'm going to show you an example in real time that happened today in the NASDAQ about how a poor high or a poor low, weak high, weak low indicates an unfinished auction. We see a poor high or a poor low. This is an unfinished upside auction. It doesn't have to be revisited that day. It can be days later or sometimes even weeks later. By that time, it's pretty much moot. But anomalies, again, anything that sticks out, anything that doesn't seem to fit a smooth bell curve. Okay. So there's, different things about the auction process. There's time. Is the market continuing to spend time? That's acceptance. Volume, also acceptance. Value, that's the area of value. Open interest. Is money coming in this direction or is it leaving in this direction? Confidence, conviction, direction, momentum. These are all things that we can use subjectively to look for opportunities. So I'm going to move on here to naked points of control. This is the regular trading hour session profiles on Trade-Evade. The Trade-Evade the trading view also extends points of control into the future. So what we're looking at here is the S&Ps, the December S&Ps, today's profile right here. And so where did we trade to? Well, this is the TPO point of control from yesterday, right up here. We didn't quite get there today. We did, however, get to the naked point of control, volume, and TPO points of control from this session here. Do we have any leftovers down below? No, not. I mean, we would probably have to go pretty far back to find it. We do have one, and it's on my TradingView chart. This volume, this TPO point of control right here, I think we were looking at 37, 36, that area here. It's yet to be revisited. What do you see? If this market continues lower, this is a visual target that is likely to be revisited if we check lower. Do we have anything left above? We have this little TPO up here. But when we look back, I mean, look at how disorganized this move to the downside was. We left points of control, TPO point of control right here, TPO point of control right here. Look at when the market pulled back where it went to. So we had these that were extended, market moved lower, didn't leave any naked points of control here, but when the market returned back to this area, the target was the volume / TPO point of control on the way back up. Naked points of control are magnets for price. If traders are focusing on a specific price level, they have a tendency to bring price to that level. Here we have another naked point of control. TPO point of control here was checked that day. Nothing left, nothing left, nothing left, nothing left. Bit of an anomaly down here. That'll be interesting. We have one TPO point of control left in 3 weeks of trading. Wouldn't surprise me to see price get down to that level today. Wouldn't surprise me. Now, the NASDAQ today, we had a weak low, poor low, as a matter of fact. Weak low, poor low. Here it is. A period traded down to here. B period came down and took out the low of A period by one TPO. One TPO. Now, in the NASDAQ, because it's such a volatile instrument, I use 4-tick TPOs. Doesn't change the fact that the market looked below A period, little to no excess at the bottom. I said, Michael, I'm kind of nervous about that weak low. Be careful if you're looking for longs. We had 1, 2, 3, 1, 2, 3, 4 lows right here. This is definitely a weak low, and look where the point of control ended up being. Okay, so you could go back and listen to it on YouTube if you want to, but at the end of B period, I said, Michael, there's a weak low here. I'm not that interested in being long anymore because of that. B period left excess, a selling tail, excess. Auctions, the auction process dies in excess. It dies in excess. Now, hang on 1 second. Let me make sure I've got everything covered here. Okay. All right. So, okay. So I'm gonna run to the questions here. Okay. All right. So there are videos that are on our YouTube channel that I can, I think, provide for you. And it's about market profile and the auction process. The auction process.
Hoag, I think that we'll also probably cut this. In fact, we will. We're going to cut this session out and post it to YouTube as a standalone.
Okay. All right. Well, then, I won't put that in there because I mean, a lot of this information is still is from that session. I don't really get into the auction process too much, but I just want to answer some of the questions here, and then we'll let everybody get back down to business. Okay. Let me see if I can find the beginning of it. Maybe I'll just start at the bottom and get what I can get done. When you look at the market profile, you look only at regular trading hours or including the electronic trading hours. This is a really, really good question. So this is this one has the regular trading hour session as well as the overnight session. If I'm going to be looking at the overnight session market profile, it has to be separate. And there's only two things or three things that I'm focusing on in the overnight profile. It's the high, it's the low, and it's the point of control. I want to know what the overnight high and what the overnight low was always. And I want to know where the fairest price of the overnight was. And that's it. So generally speaking, I'm looking at the overnight session using just the 30-minute chart, because then I can see what the overnight high and the overnight low is. Too much of this on the chart, and it tends to confuse me. And if I were to add the overnight sessions on here, it would end up screwing up some of the TPO extensions. I'm sorry, some of the point of control extensions, so that I wouldn't be able to see my naked points of control. It's kind of funny they call them naked points of control. The only reason they call them that is because they have not been revisited. We've got one TPO point of control. I know it's hard to see on this platform. It's a little gray line right here. If I expand it, maybe you can see it better. There it is. So there's the widest line of TPOs from that day. The point of control comes across, and we'll see if it gets revisited. We'll see if it gets revisited. We'll try and remember to talk about that. There's a really good question. Is this info extendable to the SPY also? Any market, any stock, anything that can be bought or sold is part of the auction process, of an auction process. And I believe that the market profile can be equally as valuable in anything that you can buy or sell. It wouldn't surprise me to see the producer of a product, let's just call them widgets. And the company that sells widgets is doing studies to find out the right area to price their widgets. So they're going to price them high and they're going to price them low. And once they find the equilibrium where people are actually buying them, but not emptying the shelves of them, that's where they're going to find value. And it's just the same thing if you look at Kelly's Blue Book, you're looking for a car. They create a bell curve of what's too expensive for that car, what's too cheap for that car, and where the majority of the transactions have occurred. It's anything that has an auction. Okay? Equity guys probably don't. I don't think anybody that trades Forex understands the market profile either. I don't think that there is a platform for Forex that provides the profiles for you. And then one thing about that is you're going to also be missing the volume in Forex. Okay? So it's better to enter on a thin profile. Well, at the thin ends of the profile, so let's say here, one of the things about the profiles is the earlier you can figure out what day type you're going to have, the better off you're going to be. I mean, let's look at yesterday. So we opened, we looked lower, we drove higher. We continued to drive higher until we got up to here. A little bit of excess up here. If I'm going to do anything here in the middle of a day that ends up range bound, my risk is all the way down here for longs. My risk is all the way up here for shorts. But if I time it right, if I get to the end of the auction where volume dries up, buyers won't buy it anymore and sellers will take over, then I can take this move to the downside. Now, yesterday, during the interview, we got up to 44.19, which is my weekly kickoff high. Normally, and in my own account, I would take that trade and put 10 points of risk on it because it's an important inflection level. Now, I didn't have enough space in the account that I use for TopstepTV, so I got stopped out on that, and then watched it go all the way down. But that doesn't mean that's what happened to me outside of that account. So, but if it was at an important inflection level, volume was dying out on the way up. We put a degree of excess at the high. We were above value. This is a better place to take a short than this is any day. Any day. The only time I'll take a trade at point of control is in a directional market. A directional market. Okay, so I'm always focusing on the extremes. Here's a little hint, and we talked about this during I don't remember when we talked about it. It was this week, but when you think about the initial balance, it's about 65 to 70% of the time when one extreme of the initial balance will be an extreme of the regular trading hour session. Watch. 1, 2, 3, 4. No. So 4 out of the first 5. So we're looking at 80%. Ooh, just a little bit of a look. We won't call that an extreme. So 4 out of 6. 5 out of 7. No. 5 out of 7. 5 out of 8. 6 out of 9. No. 6 out of 10. So we're at 60%. 6 out of 10. 7 out of 11. 8 out of 12. No. 8 out of 12. 8 out of 13. 9 out of 14. 9 out of 14. We'll just get to 20. 9 out of 14. 10 out of 15. 11 out of 16. 12 out of 17. 13 out of 18. 13 out of 19. 14 out of 20. So better than 70%. Approximately. So if you can pick the right end, you're going to be all right. The problem is early in the session, how do you know? How do you know which one? Okay. Renard, this isn't magic. It's how the markets work, right? If you really want to get into, get yourself this book, Mind Over Markets by James Dalton. Jim doesn't even like this book anymore, but there's an abridged version to it where he's added some information. And then read this one, Markets and Profile. This one gets a lot closer to a little bit more technical information in it. great books. And there are lots of good books about market profile. The original text is called Markets and Market Logic. It's by a gentleman who's still with us, like Jim Dalton is, by the name of Pete Stottlemyre. They were both kind of working on this theory, kind of at the same time. But again, I have to remind you, it's not an indicator. It's not going to say buy here and sell there. It's a tool to put the market in context of the auction process. Now, the next time we get this deep into the profiles, we're going to go deeper. We're going to get into volume, open interest, and delta, which I know is a kind of a touchy subject because so many platforms do not provide regular trading hour delta. But I'll show you an example of one of the most stark examples of open interest volume, open interest, directional activity, and delta that I've ever seen. It was in gold in early 2022. I will show that to you the next time we get together and we kind of focus on the auction process this way. And if you're in a market, I mean, you're asking about crude. Here's the crude TPOs. Here's the crude. Here's today's market profile. Here it is on the other platform. Same thing. Same thing. Got a little anomaly down here. Little anomaly. We have excess low, low excess high, no gap close. We get down to that anomaly. Holy cow! That's that. Well, I mean, we're about to close here in gold, so not that impressed by anything that I'm going to see for the next 20 minutes here, but it works and I hate even using the word work. Nothing works. It's up to our ability to use the information to make it work for us. There isn't an indicator that works. There's no technical analysis that works. It's up to us. It's up to us. Is this part of how I build my weekly kickoff levels? You betcha. You betcha it is. You betcha. So, everything we talked about today, of course, is for educational purposes only. We didn't talk about the purchase or sale of anything. Make sure you're familiar with the CFTC disclaimer. Just take a quick look at it. I should probably have it memorized by now, but just protect yourselves, ladies and gentlemen. I want to finish this with one of my dad's wisdoms. And I'm sure he stole this from somebody, like he stole most of his wisdoms, but he was a trader for 40 years on the Chicago Board of Trade during the heyday of the grains. And he was always, pretty quick to give me enough rope to hang myself, but always there to laugh at me when I was down. And he always said, it's not the things that you don't do it's not the things you do that you will regret. It's the things you don't do. It's the things you don't do that you will regret, not the things you do. So do what you got to do. I was watching Corbs and Michael. It was a great interview. He's much like me, believes that just about anybody can really do this. It's a matter of doing the things that are in your best interest with everything you do. Do the homework, learn, figure out what works for you. Because something that works for me isn't going to work the same way for anybody else. And, I just look forward to the success of everybody. I know that that's not possible, but I want to see as many people as we can get to succeed at this. And And I will look forward to seeing you all again tomorrow on the opening call. And, when we get enough thoughts, we get enough ideas, we get enough questions, we'll kind of review this and move a little bit further down the road into the auction process. Blessings to you all. Trade well, and we'll see you tomorrow morning.